Hello, am I audible?
Yeah, good afternoon, friends. Friends, I am Ashish Agrawal from Resurgent India. Uh, so, as you know, Resurgent India is a registered merchant bank, and we run this knowledge series since last 4 years. We have completed more than 150 webinars till now. On more than 2,000 speakers or the industry veteran had attended these webinars as a panel speaker. So in this knowledge series, today we are organizing or we have organized this webinar mainly on the diversification of funding sources by NBFC in the current scenario. We have the panel speakers; those are industry veteran. They have vast experience on the both lending and borrowing side. So first of all, I would like to welcome to all of you, all the panel speakers, for taking time and joining with us in this webinar. All of you are very busy in your practice, but you have shown this interest that you want to give back to something to our industry. So definitely, this is a commitment from your side, and it will be helpful to the industry. Your views and your deliberation will be helpful. Then I would like to welcome to all the people who have joined us from the industry or from the outside the industry also. So we have audience which is from NBFCs, and they are bankers also. We have professionals also, and then some people are joining from the global market also. So everybody would like to know that what is happening in India, the NBFC market. So just to give a brief outlook, if you see and across the world, we call NBFC as a shadow bank, and we see the shadow bank, the overall shadow bank size in the different countries in comparison to GDP of these countries is much higher than the India basically. So still we are way behind of the overall GDPs versus the overall book size of the shadow banks in India. So India is something around 10% of the overall GDP in terms of the shadow bank overall book or the AUM. While if we see the China and other countries, they are more than 50% of the GDP actually. So still we are way behind, and we have to figure out that how we can grow fast. And on the other side also, there are a big chance that India will become the third largest economy by within 7 years or within 5 years rather, the 7 trillion GDP. So this is again another big opportunity for all the shadow banks, all the NBFCs to grow faster also. And this has been said by the IMF. So International Monetary Fund actually has projected that India will be the third largest economy in the world within 5 to 7 years. And if you see, according to the McKinsey report, India is still underserved actually in terms of credit market. So 50% of our population is still having the not having the credit lines or credit opportunities. So they are not having a single credit line also. So this is again a huge area or huge opportunity for all of us to serve them, because NBFCs are meant for majorly for the underserved and unserved market actually. So in the overall economy, or I will say in the financial ecosystem, the NBFCs are very important, and they should have the continuous availability of funds at the reasonable cost, and the long-term funding also. So these things are there which are very important. In today's webinar, we will discuss that what are the options which are available for funding, what are the challenges are there, and how our panel speakers are practicing in day-to-day life to diversify their funding sources also, and what are their views about the different funding sources also. So we have prepared a small PPT, which I will request to Ayush, please start that PPT, which will give you some overlook about the outlook of the overall funding to NBFC space from the different sources. So friends, if you see, these are the different funding sources in the NBFC space on the liability side. So traditionally, we see the bank loans still it is on the higher side, and the capital market, there's NCDs and CPs, which is again since last many years. Then one more thing, this NBFC to NBFC. So many large NBFCs are lending to the other NBFCs. So these are the traditional sources. You see the evolving funding options. So DAPTC market, which was very small some time before, but now it is growing day by day. Co-lending is the new baby in the entire ecosystem, which is growing very fast also. Private equity, although it is there in last many years, IPOs are also there because many NBFCs are now coming up with the IPO. If we see in the last 2023-24, I think more than 20 NBFCs have come out with the IPOs, both in the MSME and the main board. ECB by GIFT City, because now the India is also having the offshore setup where country within the country GIFT City. So ECB is one of the area which is growing from that market actually, because now the accessibility is easy actually, reach is easy also. DFI, the developmental financial institutions, they are also having a lot of interest to lend money or to invest money in the Indian NBFC system. Yeah, next slide. Ayush, next slide. Ayush, can you just go on the next slide? I think there is some problem. Just to give you brief outlook. So as I told that there are 7-8 areas of yeah. So there are 7-8 areas where the NBFCs can raise funding. So if we see in the last 5-6 years the trend of bank funding to NBFCs. So if we see that this table, it has increased to fourfold actually, from 4 lakh crore in 2008 February 2018 February. It has reached to 15.5 lakh crore in 2024 actually. So if you see the growth is very good actually in last 5 to 6 years. So 4x growth is a very good growth. And we see on the mutual fund side, it is degrowth. The growth is not there actually, rather it is degrowth actually. So from 2.3 lakh crore to 1.9 lakh crore actually. So it shows that mutual funds after this ILFS and DHFL fiasco, mutual funds are still having a lot of, I think, challenges in their mind, and they are going very slow to the NBFC lending actually, or an exposure in the NBFC by way of NCDs or CPs actually. And if you see the overall risk weight or overall growth in the NBFC advances in the banking system, it's less than the overall credit growth actually, the December 2023. So percentage wise, on the aggregate basis, it has degrowth actually. Then we see the co-lending. So last year, March was something around 25,000 crore as per the some numbers. And this year, it has reached to 1 lakh crore. So it is again in 1 year, it's a threefold growth actually in the overall co-lending space actually. So it is clearly seen from that the co-lending co-lending is growing very fast in the entire ecosystem actually. As a tool of one source of funding for the NBFCs actually. And we see the overall bank advances to NBFCs. This is a very alarming figure actually. It is something around, it has reduced to 19%, while it was something around 23 to 25% actually. So although the 4x growth is there in the overall NBFC funding last 6 years, but in last year, the percentage growth in the overall advances to NBFC bank, it has reduced from 3 to 4% actually. So it shows that that bank funding is getting in terms of overall bank funding is reducing in the NBFC space. Next slide. So, as you have seen in the last 5-6 months, there are some news in the media on RBI also tightened the some of the areas where RBI has shown concern on the high share of the bank lending to the NBFCs, which is something around 57% of the NBFC book actually. So again, it's the largest source of the funding for the NBFCs, which is a concern for RBI, and definitely this is a topic for discussion also how the NBFCs can diversify in their funding sources actually. And then the DAPTC, we see we include it also, then the 57% will become maybe 65% or 64%. So overall 2 lakh crore of DAPTC were done in the last year. So this is again indirect exposure to NBFC. And the one new thing which the SBI has recently, we have seen the news that SBI approach to RBI that there should be a cap on the overall the lender space to one NBFC. So one NBFC. So something they have told that there should be minimum exposure by one bank to NBFC at least 10%. So as of today, we see in most of the NBFC there are 50, 40, 60 lenders are there. But if this will be applicable or RBI will accept this, I think this might change the entire outlook of the bank lending to NBFCs actually. So we need to discuss on that part actually. And again, this risk-weight circular by RBI, where the most of the NBFC which are to consumer credit, they got hit actually, and the retail loans also and the unsecured loans. So this is an area of concern also, which we need to discuss. We'll understand from our panel speakers what is the impact of it on their funding availability and how it will impact in the future also. Yeah, next slide. Yeah, Ayush, next slide. Yeah. So what we think of what the NBFC should do, they should reduce excessive reliance on bank funding. So we have seen the 57% in the overall funding of NBFC from bank. So how we can reduce it to 40% or maybe 50% in this year or maybe the next year, maybe 40%. That will be helpful, and that's the objective of RBI. So we have to find out the new sources of funding. And they need to, the NBFC which are eligible for the ECB funding and the developmental financial institution funding, they should try their source because it takes time to get money from these sources. And securitization, definitely many of the NBFCs are doing, but this can be increased also. And the co-lending and NCD market, which is also an area which should be seen as a risk mitigation also, or as a diversification in the funding sources. Next. So thank you. So friends, this is something which we thought let us bring to you basically, although you are aware and you know this basically, but just to set the tone of the webinar and give the food for thought also. So now I would like to invite panel speakers. Those are better in the industry and they know that how to basically diversify in the funding sources, and they are practicing it also. So among us, we have Ajit Kumarji. Ajit Kumarji, the CMD of a group called Safe Group actually, and they have multiple NBFCs within the group actually, and they have very vast experience of lending and the fundraising also for the NBFC. So Ajit ji, first of all, I would like to welcome you and would like to thank you for joining with us. Ajit ji, I think your video is on off actually, and now you are
Yeah.
okay.
Great. Because I am traveling due to bandwidth network issue. That's why
I can understand.
switch off my
That's
video.
why I've taken your discussion first actually, because then you will have some
Yes.
relaxation.
And thank you for giving us opportunity. Thank you, and good afternoon to all. And it may possible some inconvenience due to my traveling. Really very sorry.
No.
And as you said, sir, this is a very crucial day for the NBFC because SBI also approached to RBI to reduce the many bank exposure in NBFC, and other RBI also warning to the bank you should not give more exposure in the NBFC and unsecured funding. So I think there are 3 to 4 way. Only DFI fund, and now a DFI fund is shown very good interest in infuse the money in NBFC. They are very interested. And second is yes, equity is a good proposition, but only equity we can't rely on the only equity and depend on equity. So it's a like foreign funding is like a debt fund and other DFI fund. And now today is a very good alternative for the funding is a co-lending. And all bank directed by RBI and DFS used to start a co-lending, and all bank want to reach in rural area to serve the customer. And only vehicle of the NBFC they can serve through NBFC they can serve in the rural area through NBFC in the only model is co-lending. So I think this is a very good and as per as my experience, I am also co-lending partner of the two bank. One of the SBI largest bank, and other is the Federal Bank. We are doing very good, and we have they funded more, and it's a very good alternative for the bank dependency fund. So this is thank you from my side only.
Sir, so I think it's good actually that you have covered up these two new things basically. One is that co-lending, another is the DFI funding actually. So we like to more from you if possible. What is your experience? You rightly told that it's a good experience, but if we compare with the bank lines, so bank funding versus the co-lending, what are the things which you think that these are important to consider for co-lending from co-lending point of view? Because the cost of borrowing or the ease of getting funding also, these are the areas which need to be seen. And ALM issues are there because many times when you are in the long-term funding, then these areas are also there. So DFI funding and the co-lending, these two different source of fundings are there. But so you, because as you told, you have already tied up with two banks of the co-lending. So what is your experience specifically on the co-lending side, and how you suggest to other NBFC? Because there are NBFC which are small also, there are NBFC or large also. Just to give you the perspective, because I am dealing or we are dealing with large NBFCs also. And so when we talk to the large NBFCs at AAA and AA, they said we are not required to go for the co-lending because we don't have any challenge in terms of raising equity and debt actually. So what is your thought behind that, and how do you suggest people to go for the co-lending, and what challenges you have faced which you can discuss here if possible?
Yeah. Sir, it's a very just we have started co-lending model with SBI 1 year back. It's a very early to say because it will come result after 1 year and 2 years, like industry experience. And I think it's a small NBFC, mid-size NBFC, very good. They should go with the co-lending because ease of the fund, no limitation of fund. But only issue is the technology challenges, and then second thing is a very good for customer also. And but I feel my opinion, co-lending is the future of the microfinance, because nowadays microfinance is charging up to 24 to 25, 26% because the cost of fund when a bank will stop the funding to the NBFC, may in other private NBFC, big NBFC and other private source cost may be up again. Interest rate will they will charge more interest rate. So it's a co-lending. If you do go with co-lending with other bank, they definitely customer will get a loan up to 90 to 20%. The 4% cheaper rate of interest to the customer, and there are no limitation and ease of the fund. This is a very good proposition. But triple A rating, they have a good source of fund, and every bank and other sources are willing to put more money in the double A rated company. That's why they have a good source of fund. They have enough fund, and they not able to deploy his own fund. That's why they did not like take this opportunity to co-lending opportunity. So this is a very good proposition for the like a startup, new NBFC and mid-sized NBFC for the co-lending. And second is the DFI. DFI taking too much time, like a 1 year the time they will take to put the money, but it's a very good option, and they provide long-term fund up to 5 to 10 year and low cost of fund. So NBFC, mid-sized NBFC should focus on the DFI fund and co-lending model only.
Okay, so from your point of view, both the product or both the sources of funding are equally good or better than the bank funding. So the NBFC should try. And you have rightly told there is no limitation of funds in co-lending, and the customer is also getting benefit. So you are in a better position to compete with the market also. And
Right.
on the DFI side, you said long-term funding, which is the advantage in that side. Thank you, sir. Thank you for giving that perspective. I'll come back to you again. Come back to you after the discussion with other speakers also for more
Thank you, sir.
discussion. Yeah, thank you,
Thank
sir.
you.
So, sir, we have Saxena ji. Saxena ji, Harsha ji is having very, very vast experience. And first of all, Harsha ji, welcome to you.
Thank you.
And Saji, you have experience of corporate side also. You have now champion of NBFC also. So we like to understand from you because in your business, which is doing by Oxilo, it is something different in comparison to the regular NBFC business where the regular repayments are coming or regular in the sense that monthly repayment, monthly interest, and all these things are. You have long-term product where more has to be given and all. And other than that, also you have corporate experience. So what difference you see in the when you are raising fund for the NBFC, when you are raising fund for the corporate? So if you can give some highlight on that, that is one area. And that we have seen here, the bank funding is something around 57-60% of the overall NBFC funding actually. So what do you suggest to the NBFCs or to the other NBFC players, the NCD market, whether it is good or it is bad or it is really easy for taking money? If you can highlight on that, I think that will be helpful because you have raised a lot of NCD in your previous avatar also and now the current scenario, current company also. So over to you. If you can cover up on that, then we'll take another question from you.
Sure. Yeah, good afternoon, everyone. So the first question that you asked was basically towards the difference between a normal NBFC funding requirements and a normal other corporates that they go into the markets and borrow. So I think that fundamentally the way the lenders are looking at the NBFC sectors are very different, and when they look at a corporate like big conglomerates, is very, very different. The lenses change quite differently. And because of which the cost of funding to an NBFC generally is increased. One is based on the capital allocation that's required for NBFC while they lend to NBFC, the cost increases. Other way also is the kind of the credit, uh, I would say the credit spreads which are charged to the NBFC are slightly higher. Just to give you perspective, today when the bigger banks are charging to the extent of 9.5 to a triple B rated um, corporate also. But when it comes to NBFC, the cost of lending increases manifold. And that typically because on the, I would say, is one of the underlying security that you have. And when you lend to a corporate or to a big manufacturer, generally you have a hard asset-backed security kind of, which is in terms of available as a security to the lenders. So when that perspective has to really change going forward from the banker's perspective, they have to understand the NBFC's inherent strengths, and that actually has to boil down to the pricing of the loans which are uh, advanced to the NBFCs, I would say. So typically, one is the lenses which they wear while they evaluate an NBFC, and a normal manufacturing company has to get changed over a period of time. That's one. Uh, so otherwise, also, if you see the kind of regulations which are now being imposed by the regulators on the NBFCs in terms of the various disclosures, various transparencies, I think that's also going fundamental change. And RBI is insisting on more transparency and the kind of consolidation which are now SBI has asked as could be detrimental for the NBFC sector where they have to diversify their sources of funding. Of course, I agree with Mr. Ajit. I think the kind of the landscape which co-lending is now providing, or the kind of DMI, or the other people who are providing in the entire process. Of course, bond markets are still yet to develop in the country, I would say, to extent, because if you've seen the mutual fund exposures have come down, as rightly pointed out by you, over a period of time from almost to 2.5 lakh crores to around 1.7 lakh crores. So one is NBFC participation, one is insurance company participation that has to penetrate further while providing funds to these NBFCs, and where they can also. So when you go to the bond markets, the typical two challenges that you face, or particular NBFC faces, are the two challenges. One is the bond markets today is typically working on a fixed cost structure. So today, if I have a view that the interest cost may come down over a period of say 6 to 12 months from now, I don't have an option in the bond markets. So the investors there today are more, I would say, more rigid on the fixed pricing bonds right now. The market is today, which is revolved on the bond market, is toward the fixed cost. So I think the maturity on the investors from the risk management perspective and from a borrower's perspective has to evolve to a floating market, more floating rate linked bonds kind of. That is one. Second is the bond market is also today at a short end of the tenure. The funding for long end of the tenures are still not available. Of course, there is a refinance which can always be done of the bonds, which is slightly easier than a term loan refinancing. So the bond is always preferred in at the short end of the curve. But if you see there could be ALM challenges with the NBFCs. So and many NBFCs need funds for long terms, and when they are deploying capital and they're giving advances to the borrowers. Typically, the average lending tenures are to the extent of 5 to 10 years, kind of. So participation of banks also is equally getting important. And typically now, as we have matured, we have created a history of defaults and created a history of ratings. The bond markets as well as the has to get deepened through the bank participation. I think that is very critical as of now. The bank participation has to increase there, and now the second maturity should also happen that from the double A category, the investors should evolve into the A categories also. So that's the A rated NBFCs. So that's where the gap is. Of course, the HNI market has now started to develop. The family offices started to invest, and the A segment is very active right now, and a decent amount of offers are available in the A category. But still, from the chunky investors, or I would say the institution investors, the preferred category is still double A kind of. So I think that maturity has to happen, and probably if the trading starts happening, if the listing is active and these bonds are more active in terms of trading, probably the investors will have more confidence to invest for longer term because the liquidity will not be a challenge for them and they can look at for long end investment in the long run. So I think couple of parameters combined together from one from the regulator side, then from the rating agencies and from the investor side. I think together it will evolve. We are evolving in the right direction, but it's still a long way to go on the bond side.
Okay, so good suggestions. I think you've covered up 3, 4 areas where this fixed rate structure is there. Then the participation by banks is still low actually, and the double A rating, the minimum benchmark actually. So I think these things we are listening since last many years actually, and every time when any government forum, which there is a discussion, everybody is discussing on that, but still there is no headway on that actually. So it looks like that if we suggest or we think of that NCD can be one of the large area for funding or one of the large source for the funding, it will be difficult. It looks difficult actually, keeping in mind unless until these areas will not be solved or these concerns will not be solved, this cannot be a larger source of funding for but over the years we have seen a lot of because of technology, a lot of new platforms have come which are like grape kind of or maybe golden pie and all basically. So some I think 8 to 10 and where they are penetrating of the high yield bonds which are triple B bonds also, and you see that the returns are high and then investors are also putting money and they are seeing success also. So what do you think that for the small NBFC, definitely the large NBFC, this might not be suitable. Will it be a good source or it's a good source for them or there is any risk on that?
No, this is always a good source for those kind of NBFCs. So definitely it provides access to the capital. Of course, I think SEBI is will look at all these kind of platforms very closely going forward. I think regulations would get further evolved because today there's no default scenarios kind of till the trucks on no default scenarios, people and the investors make money, everybody's happy. But tomorrow's by chance if any default happens or any big default happens in these categories, then the investors understand because the kind of investors who invest on a high yield paper, maybe family offices still are able to undertake the risk. But today the bond markets have gone to as low as 10,000 rupees per bond kind of trade. That actually brings in a lot of uneducated, or I would say the financially not that savvy investors on the board, and where the risk lies from economy by a large perspective. So that may hamper kind of tomorrow if there is a default kind of thing that the entire then the SEBI becomes jittery and all the regulators become jittery and they bring a lot of stringent regulations in place. So I think one has to be cautious right now how the market is shaping right now. They have to be cautious. Good quality credit. Of course, the rating agencies have evolved over a period of time. The rating has a lot of influence now on the pricing and on the understanding on the financials and cash flows. and disclosures have also increased of the listed debentures across. So I think broadly we are following a framework, but I would say this from the investor perspective, one has to be cautious while underwriting those risks. But from NBFC perspective, definitely it provides a good solution of funds to an NBFC where funds are available through these markets, kind of the alternative structures. But this is definitely evolving market. A lot of matured investors have stepped in. Family offices are there right now, which have it and skill to underwrite those kind of risks. I think that's a very welcome thing kind of right now for the industry.
Okay, okay. I mean, that's great. I think it's a good suggestion which you are giving. And there is one more development also in the 1st April. I think the RBI has come out with some circular that banks can now keep the corporate bonds without mark to market actually in the held to maturity. So this will increase, I think, flow of NCD or the corporate bond investment from the bank side. So have you seen any such kind of discussions in the banking system or?
So yes, but this actually enables to borrow at a finer price, because what banks used to do because of the mark-to-market negatives which they had to have, and they always created a cushion while lending to NBFCs. So I think that the cushion can be sharpened, and the mark-to-market losses to the bankers would be lesser going forward. If in at all it happens, kind of, they should be more concerned of the yields which they are able to generate from a fixed structure. So in between, there are always up and downs. So with the bonds, typically we invest for a 5-year structure. There could be mark-to-market losses or mark-to-market profits in during the entire journey. At a given date, there's a profit and a given date. After a year or now, the positions might change. So, but now if you don't do mark-to-markets, the bank's financial performance can be more stable. So they will the skepticism around investing in these kind of papers will slightly go away. They should be more open to invest in these kind of papers. And I think that's been the trend also. And we have been discussing with the bankers in that same line, kind of, to improve the pricing. So yeah.
Thank you, Arsa sir. Thank you very much for your deliberation. I think it will help to all our audiences.
Thank you.
So,
Thank you.
thank you. So, friends, now we have Bonani ma'am. She is CEO of Nav Samriddhi Finance, which is the, part of the NABARD Group organization actually. And first of all, Bonani ma'am, thank you very much and welcome to you for
Thank
joining
you.
with
It's
us.
my pleasure. Thank you for the
And,
opportunity as well.
so, ma'am, you are the only lender in this group, actually, in this panel, and we all are. All these are the people who are looking to borrowing,
Yes,
actually.
other
So
side.
everybody, so everybody would like to understand from you, because NABARD is a DFI, domestic DFI, actually, practically, and you have NABARD has done a lot on the funding to the NBFC sector, actually, overall. So would like to understand how you are basically helping the small, mid, and large NBFCs from your ecosystem,
Ecosystem.
and how you are diversifying your lending base also. So because I've heard that you are venturing into the other segments of funding which we have discussed earlier, that
Yeah,
co-lending and also you can
right.
cover up on that. That will be helpful. Over to you.
Thank you so much, Ashish. It's a pleasure to be connecting, and so glad to be here as well. So basically, when we look at the NABARD ecosystem, so there's NABARD obviously as the DFI, where the rules of the game are slightly different, where we are looking at a more of impact, where it is a refinancing. So you have to first create your books and then come to NABARD for a refinancing. It comes definitely at a lower rate than I think most NBFCs can lend at. But again, NABARD has a certain segment that it's looking at. So maybe NABARD is looking at AA plus and above. And for MFIs, it may be looking at slightly lower, because for MFI, NABARD goes by the MF rating norms, so MFR 1, 2, 3, which obviously may not always be equivalent to AA plus. So therefore, many of the MFIs are able to get refinance from NABARD. However, for MFIs, NABARD's rates are slightly higher than the rate at which NABARD provides refinance to the NBFCs. So then coming to NABARD stable, we have NAB Kisan and NAB Samruddhi, which are essentially providing wholesale loans. For NAB Kisan, it's mainly focused on agri, but NAB Kisan has been financing most of the NBFCs which have a rating of A minus and above, let's say, because NAB Kisan's main focus is on FPO lending. So the wholesale loan category is almost like a niche segment here. But for NAB Samruddhi, mostly we are into wholesale lending, and we cover all NBFCs starting from unrated up to, let's say, AA plus, because beyond AA plus, that is when NABARD takes over. Number one, also, we won't be able to afford the pricing there because we get loans from NABARD and NABARD provides refinance to us at an arm's length basis. So our rates from NABARD are also higher than what NABARDs provide, let's say, to a large NBFC. So that's why our loans, we provide like starting from unrated NBFC, whichever loan book up to rupees 100 crore. That is the criteria, because beyond 100 crore, they should get a investment grade rating. When we say unrated, we mean either no rating has been undertaken or rating is below BBB minus, right? So this entire segment, then of course the Section 8 companies and non-profits, but this that's irrelevant now. But NAP Samriddhi, of course, the focus has been, as you know, on green and wash funding. So therefore, when we provide for green and wash, our rates are definitely more concessional. For wash, we also get a special concession from NABARD, which we pass on. And we add our own as well because we take it as a promotional measure. And here is where the blended finance comes in. This is what helps NBFCs, because NBFC now the main issue is the pricing, right? So, and because of, again, RBI stringent measures, of course, RBI has its reasons for everything, but still the ultimate impact we are seeing is that the pricing is going up across the board, and which is like really hampering credit growth as well. It is bound to hamper ultimately if it keeps on increasing. So to actually address this issue of pricing for impact segment, right? That's where we bring in a lot of blending, where direct grant support or subsidies or subvention, even some kind of soft loan comes in from other players, whereas we just give a plain vanilla debt at whatever rate is affordable for us as much as possible. And now where it comes to impact, why we are talking about impact here is that where we look at the future of the financial sector, there the sustainability is the main issue. So when we are looking at any kind of commercial lending, it is excellent in the short term. But if we have to look at the long term, that is where we have to look at impact. That is where the planet and the people have to come along with the profits as well. So we have seen this actually through NABARD's research and NABARD's experience in the field, that to sustain in the long run, you have to also look at ESG. So there is a lot of focus on ESG today, whether it's by DFIs, whether it's by banks also, because there will be again a kind of pressure, but mostly it's coming from FPIs, DFIs, as well as domestic NBFCs. Many of them are very keen on impact. And we are an impact focused NBFC, being NABARD subsidiary. So wherever we see that the environmental and social impact is being created, there only we are bringing in this kind of blending. Beyond this, our lending is essentially commercial, but along with term loans, we have doing a lot of PTCs. So in PTCs also, we try to take up pools which have this impact quotient. If they have, like if someone has a green pool or a wash pool, then we are more keen on that. And in that case, we try to also reduce the coupon because we are trying to promote these sectors. But otherwise, we do extensively. PTC is always around maybe some 20% or even more of our books at any point of time. And we do PTCs only when term loan is not possible. In the sense, either there is an eligibility issue or we have a slightly higher risk perception because of vintage or whatever. So that's only where we do PTC. And then we are also now venturing into co-lending in a big way. So we are just waiting for the technology to come into place, which will happen very soon. But we have already kind of developed the product and also reached out to possible partners. And through co-lending, we want to take forward not only our focus segments, but we can do co-lending for even generic MF as well as MSME loans, even unsecured business loans. So once that happens, I think we will be able to work with more number of partners. As of today, we have 83 partners, but with co-lending, we can reach out to more who we were not able to reach out so far. And regarding like our loans to any entity, obviously, we first look at governance, which is very important. If governance, transparency systems and processes are in place, The rest of the factors, the financial or the operational, it's only a matter of whether we take it with a deviation or we don't take it with a deviation, which also depends on how strong the management is, how strong the board is, and what does that entity actually stand for. So the mandate of the NBFC matters a lot. Ashish, you're on mute.
Yeah. Thank you very much for giving the perspective from your organization point of view and the NABARD, how you are seeing the NBFC sector. And the good thing is that you are diversifying the co-lending PTC also. So definitely then the RBI is saying that we have to do the less reliance on the bank funding. I think the DFIs can play an important role like NABARD and SIDBI and other DFI which are domestic DFIs, so that the at least small NBFCs can get because you are funding to unrated NBFCs also. So this can be a good tool for them because large NBFC anyway they will get money from the different sources. So that's the big thing. But you have covered one great thing, which is the green financing actually. So, and you have told that this mandate is coming from the government, from the award itself also. So what do you see when the green financing we use it, and then who can raise green financing from NEFIN or NAFSAMDADI and award? What do you basically cover in that, which kind of portfolio, and because you're giving some advantage also in the pricing when green financing is there.
Right. Yeah. So
please.
actually, NABARD has actually come out with a green taxonomy as well. But as far as NAPSamruddhi is concerned, we are very narrowly focused here because, which is, of course, it's a demand pull kind of a thing. The market has only determined that we have seen where scope is there. So EV is one sector we are very bullish on. Initially, there was a lot of concern about EV, but we were very sure of EV. And today, EV is really taking up hugely because of the infra support, the subsidy support from the government. And once things are in place, the interoperability of the batteries is happening, swapping is happening, and infrastructure is also coming up. So EV, we are very strong on. Then climate action and mitigation. Here, solar and renewable energy, again, is doing well, which we are supporting in a big way, because solar makes a lot of difference both from the point of view of the environment, also the reduction in cost for the end borrower, because ultimately most of the solar is grid connected, and whichever states the subsidy has kicked in, those states are doing better now. Rajasthan, Maharashtra, Gujarat. So these are the states we are focusing on. Then also we are looking at energy saving equipment. Here, a lot of innovation is happening in India. India, in fact, is a mecca of startups, I would say, and startups are coming up with a lot of innovation where energy saving is being researched on and innovated, and this is across sectors. So this is sector agnostic. Wherever we find energy saving equipment and solution, if that is being financed, we are very keen on that, and it's happening also, whether it's medical equipment, whether it's industrial equipment, whether it's a climate ready wash, because we have just pioneered a climate resilient or climate ready wash funding program since November 23, and we are building capacities across the board now. So first of all, building capacities of MFIs, of NBFCs, then building capacities of their end borrowers, and then one-to-one training, exposure visits, everything is going on. Some of these programs are through Sadhan and some through water.org. So through this, we are trying to make WASH more sustainable. And in that, there's a lot of advantage for the end borrowers. So wherever there is solar powered pumps, so we can give a piped water solution, but the household will need electricity, which may not be available all the time. Plus, it may be high cost. Not electricity is not free everywhere. So solar power pumps come as a solution. Rainwater harvesting, which recharges the borewell, is totally something that is climate focused, because the water table has gone down. We know the situation in drought affected areas. So in these areas, we are for this. And wherever we have some very specific flood resilient and drought resilient toilets at household level, we are supporting those. That's through MFIs, through NBFCs. We are trying to support MSMEs who are bringing in this kind of innovation. lot of innovations are going on in water treatment, in FSTPs, that is fecal sludge treatment, in waste management. Lot of innovation which helps to save energy as well as cost. So it's green. And also there are innovations which try to find solutions to reduce drudgery for, let's say, sanitation workers, or which help to bring in more vendors and masons and plumbers into the space. So Finish Mondial is one other partner which is training up masons and plumbers and vendors and bringing them together so that they can be financed. So the entire value chain of green and wash we are trying to support, not only by financing but through entire ecosystem support, like building of capacities, knowledge, spread of knowledge, more of R&D, and bringing the stakeholders together. We are planning a marketplace also for this, so that the OEMs, the vendors, the dealers, as well as the ultimate users can come together along with the financiers, so that climate ready wash can really go ahead. So this is also some offering that we have in mind for this year in plan.
That's great, ma'am. I think you have covered very well, and this is something new which the NBFCs can think of. And
Yes.
I hope that you will be getting a lot of queries also on that side actually. And you are helping not only in the funding, but you are helping in the capacity building also. So I think banks should also take the lead from NABARD actually, that this kind of support will help to meeting out the net zero target of India. And the people who are the rural areas and the semi-urban areas, they will be in a better position in their lifestyle and all. So that's good actually when you are covering a lot actually, and you are giving multiple solutions or multiple funding options to the NBFCs, which is helpful actually. And this RBI concern about that bank funding, reliance on bank funding, less reliance on bank funding will be helpful through Nav Samriddhi. Thank you, ma'am. Thank you for your deliberation. I'll come back to you also after this deliberation from Mr. Aishwarya. So Mr. Aishwarya Kandalia is the head treasury of Vastu Housing Finance. And Vastu Housing Finance, everybody knows they are into affordable housing. So, Aishwarya ji, first of all, welcome to you in this webinar. And as you are basically having vast experience of fundraising from different sources. And at Vastu, you are having the investors also, which are equity investors, which are large investors in your overall investment kitty. Then you have DFI funding also, ECB funding also, because we have covered a lot on this NCD side and all. So we would be happy to know from you what is your experience in the current scenario, keeping in mind the RBI I think announcements, 2, 3 announcements came in the last 4, 5 months, and which is a fear in the market actually, because in last 2 months I met with almost 100 NBFC, which are mid and large and small. Everybody is having this concern that this might be a situation this year that we can get less funding. So we have to slow down our growth or something like that, or we have to rely on co-lending and other. So the one is the direct source of funding is which is bank funding, and then other tools are there, DA and all. So from your point of view, what is the current scenario? Because you are a large NBFC, or you have NBFC also, HFC also. So because everybody would like to listen from you as a treasury head also, and the large company. How do you see this scenario, or how you are planning to go further in this kind of scenario, or are you facing any challenge in the fundraising in this current? So over to you, Sharad.
Thank you, Ashiji. Good afternoon, everyone. You rightly pointed out, that there is a lot of news that the SBI has reached out to RBI saying that they should be the NBFC should be funded by a limited number of banks, right? And RBI has also been very vocal about excessive funding of the banks to NBFCs. So in this scenario, I think DFI funding or ECB is a great source, for us also, particularly we are exploring a lot of DFIs. Currently the DFIs also are, I think, keen to, give money, because, let's say for NBFCs like us, who are also fitting in their development criterias, somebody like say ADB, IFC, USDFC, all of them are probably, a lot of news in the market. You see everybody is, sanctioning some amount of, funding to the NBFCs. Plus, you also pointed out in your presentation that, with the gift city thing also, so there is some saving in terms of withholding tax, right? So banks are also keen because, there is a lot of focus internally with the banks also, so all of them has opened their offices in gift city, and, they are also keen to, do some business from that. I think, NBFCs can also, benefit from that, so they can target where the banks' interests are also, and, get some offshore funding. Uh, so there's a risk. So, traditionally the ECBs were always expensive, apart from DFI's money, there also, there are very limited number of DFIs whereby the cost of fundings are really cheap. Otherwise, most, traditionally the ECBs are either at par or, maybe 30 to 40 basis point expensive on a fully hedged basis, vis-a-vis where the bank funding is. But, RBI has done phenomenal job in last, 2 years. The rupee has been very stable, so which helps, companies in India, to raise funding. The interest hedging cost has also reduced. In fact, the interest rate differential, which is the main driver of, hedging cost, has, narrowed. So traditionally, between, let's say, India and US, the differential was somewhere between 500 basis point, which is now, bridged to, say, 175. So which is also helping, in terms of cost benefit also. Plus, RBI has done a lot of work on the interest rate derivative side. So Harshaji was saying that, it is difficult. So basically, of course, we would not want to say, if your view is that, the rate cycle is peaking, and, you would not want to take a fixed rate funding. Let's say, so ECBs also you can get floating or fixed, but, now you have options in the interest rate derivative market whereby, you can use overnight index swap. Whereby, you can convert your fixed rate funding to a floating rate funding. So traditionally, for an NBFCs, they can probably, if you are more inward looking, what you can do is that, some portion of your funding, if you are able to tap DFIs and have a larger, let's say, a longer term funding, and, so which would, let's say, maybe inexpensive in nature, but you can use different derivatives, whereby, you can manage your risk. Then, because your ALM is strengthened, because, part of your funding is very large in nature, then some portion of, you can tap CP market. So overall, there are different ways whereby, you can reduce your cost and strengthen your ALM and manage your interest rate risk. It's just that, I think it is good to know all the instruments, and, be very cognizant of, your own need. How is your ALM looking? How is your liquidity looking? What is the portion of your fixed floating on your borrowing side and on the, let's say, asset side, and, uh, use everything in a proper lever, so that, you are able to have a solid ALM and also manage your cost well.
Okay. So you are advocating that this ECB DFI funding is good still if it is cheap, maybe costlier, maybe 30 to 40 bips, but you have the advantage of diversification.
Traditionally it have been, but now, now the things have changed, right? As in currently in this market, the ECB on a fully hedged basis is at par where the cost of funding for the bank market is, right? Plus, traditionally, there is a lot of interest in the Indian market now, with our GSEC getting included into JP Morgan bond index and Bloomberg bond index. So what is happening is that, the spread is getting compressed now. So earlier, because the cost of funding is dependent on where the GSEC is, and then SDL, and then let's take corporate bond, right? As in, for us. So eventually, if you see, our rate has behaved very well, right? In US we have seen, rates moving by 300 400 basis point for us. We have seen 590 on a 10-year benchmark, and now we are trading at, say, 710. So overall, we have behaved very well in terms of, rate environment. There are a lot of interest, whereby, the spread for us has reduced, both in the corporate bond spread in the local market, and also, the spread of, for Indian companies overseas. So eventually, what has happened that, the on a fully hedged basis currently, the cost of funding for ECBs and for, say, Indian money has, is come at par now in this market scenario. And now further, you can use different derivative structures, which depending, how your balance sheet is, you can even, get it cheaper.
Okay, so ECB and DFI can be an alternative source of funding also, while the banks are getting slow, or maybe RBI is giving them
Absolutely.
costing that in terms of increasing of the funding to bank from banks. Then on the equity side also, because the you see that although RBI has this covenant 15% car is there and all basically. So what do you think the coming years there'll be the less leverage by NBFC because the bank funding will definitely be reduced actually, and they will go for the other solutions like co-lending and other things. So from equity side, what do you suggest? NBFC should go for the higher equity component in the overall funding mix because I think Bastu has this strategy also. So if you can comment on that and how costly is equity in comparison to the debt actually. So because many times people are saying that equity is having a lot of other things also. So if you can cover up on that, I think will be helpful.
See, of course, see, equity is of course the most expensive form of money, and with the way RBI is looking at NBFCs, I think gone are the days whereby you can run 5 to 8x of leverage, right? As in currently to our mind, going forward, 4 to 5x of leverage is where people can work and still can deliver return to say equity shareholders. ROE, they can manage their ROE by doing a lot of DA and co-lending, right? So basically, on book leverage is less, but if you are able to have a mix of on book and off book, whereby you have some fee income and increase your ROE.
Okay, so whenever we are talking to the NBFC, they are saying these off-book tools like co-lending, DA, PTC. Uh, Whenever they are going to the investor for equity raising and all, they are not valuing these things actually. So is this right, or because they have this fear, or they have this notion on their mind also that on-book portfolio is very important rather than the off-book portfolio. So is this correct, or what you want to highlight on that?
I think there has to be a balance mix between on book and off book. If you see at the co-lending market, it has picked up in 5 years, from 0 to 1 lakh crores, right? So that means there is interest in the market, right? Let's say MF exposure, as you rightly pointed out, is only 1.6 lakh crore. We see that on the co-lending is 1 lakh crore. So between off book, if there is a fine balance, which can be, let's say, anywhere between, say, 20 to 25%, right? Or say 25 to 15%. I think it's fair enough, right? Because it is a interest earning asset for you. You still get interest income on that, going forward. So and you keep managing it. You also earn some fee income. I don't see a reason. Why the I think we are of the opinion that of course it cannot be very large, but a fine balance is really wonderful.
Okay, good. So, Harsaji, now I'll come back to you. So, we have discussed on the various funding sources and how the practitioners are seeing it actually. So, it's not like that the bank funding is the only source. There are other tools are there, but definitely we have to have the right mix, which is important actually. We go down the operational side, this whatever the scenario, although we have seen COVID time and after COVID, the NPAs are now reducing not on the BFC system, but in banking system also. But what do you see in the future actually? Because RBI is giving a lot of warning or a lot of cautions they are giving actually in terms of unsecured loan, personal loans. Today also I've seen the Deputy Governor, RBI Deputy Governor article in the newspaper that NBFC should have the very robust database, also robust underwriting. Then this unsecured lending, personal loan lending, and all these should be reduced, or they should be very careful. So what is your own take on that actually? Is this, we have reached to a saturation stage where these kind of loans are already very high in terms of the overall lending, or we have to be, we should focus on that also. Although this is not directly related to your business, but being an industry practitioner, you can comment on that.
No, I think as we are moving and in that trajectory of 5 trillion economy from 3 trillion economy now, so I think a lot of financing will be required at all levels. You can assume the kind of financing which has happened in the last 70 years, probably 70% of that financing has to happen in the next couple of years to increase the penetration, and for that the right steps have already in place. The financial inclusions have happened. So fundamentally, we should not. It's not a very apple to apple comparison of a credit penetration kind of, or in terms of credit growth, because fundamentally the borrower market has also changed. The kind of rebound the MFI industry has shown, the kind of financial inclusion happened, the kind of bank account which is open now, the kind of UPI segment, the transactions which are happening through UPIs right now. So all those things are now, and the kind of footprints which the borrowers are now creating in the bureau, the kind of first time in the credit bureau, the first time people who are having footprints on the credit side are immense right now. So that is, all these things are very, very positive. And the financial, under financial inclusion, the growth has to come here. Now, who takes that initiative? Probably it's the bank who will take the initiative, or it's the NBFC who will take the shadow bank that you just said will take the initiatives. I think the NBFCs are taking a very good role, and like company like us who are financing students who travel abroad, and we are actually giving our 50% of the portfolio goes to people who are new to credit. So those are the people who are the aspiring credit and the future of the nation today. They are very young people, 20, 21 years of age, and taking a loan of 20 lakh to 30 lakh rupees loan for their further studies. So I think fundamentally growth rate has to be there kind of, and for that NBFCs and banks both have to come together, and the financing has to deepen from here kind of, for sure. Uh, I hope that answers the question, or anything I missed out.
And it's good, I think, because RBI has this concern actually. So Bomani, maybe there actually. Bomani, ma'am, do you have any take on that? This unsecured lending, personal lending, because you have 83 partners, you are dealing with many NBFCs also. Do you see any challenge in the future or in the current book also, any such challenge there in terms of portfolio quality? Otherwise, RBI is giving that kind of concern to everybody.
Yes, where it comes to unsecured MSMEs, unsecured SMEs or unsecured business loans, we have seen some stress, in fact. But thankfully, wherever we saw the stress,
MSME,
some
personal
kind of,
loans.
even personal loans we don't do other than educational loans, right? So like Oxilo is our partner, then Incred is our partner. So only for education loans we do, and for two-wheelers and three-wheeler vehicle and education. Other personal loans are something we do not have in our portfolio, and we don't have when we don't do it as per policy as such. But where it comes to education loan or any, in fact, doesn't matter. It is sector agnostic, right? If there is any kind of such regulation, it is going to impact the sector. So when we say that there is more capital required, more risk weights required, it is definitely going to bring, like already the costs have increased across the board. We have seen that the pricing is increasing, and to sustain this kind of pricing is very difficult because NBFCs finance a
Voice is
particular
breaking in between,
segment.
ma'am.
Right? Yeah. What happened? Hello.
Hey, please carry on, ma'am. I think there's some voice was breaking actually. Now you can carry on.
Okay. So the impact of any kind of cost, whether it's risk cost or any
You
other
can
cost,
switch off your video,
obviously.
ma'am. I think that will be
Okay, there is an
better.
issue. Okay. Yeah. Am I audible now?
Yeah,
Am I
please.
audible now? Wait, one second.
I think there's some problem. So
I think this
no,
is
no
better.
issue, no issue.
Am I
So
audible now?
Ashara, what do you think on that actually? Because this is an issue which need to be discussed with the industry practitioners on this unsecured business loans, unsecured loans or personal loans and all. Is it impacting the, although I think you are not into that segment, but you would like to comment on that, Sharon?
No, basically, because we are not in that segment, but we have not heard anything, in the industry also regarding the same, but would not have a very, inside view on that.
Okay. So from your point of view, although you are not into that business, but there is no such any situation which is creating some kind of chaos or something. Uh, okay, got
So
it.
as I said, with the conversation we have in the
As you
industry.
covered this on the ECB and hello, yeah, please.
Yeah, please go ahead.
So as you have covered on this NCD, sorry, in the DFI and ECB side, co-lending is one of the tool. I think you have also many partners with whom you are doing co-lending. So
Right.
do you want to cover up on that, your experience on that, any guidance to the people who are here to listen to you?
I think, on the co-lending side, there is increased interest from the bank side as well, and of course from us, or from the NBC side, there are, of course, because it's a new thing, it's hardly 5 years, so there are so many teething issues, let's say on the accounting methodology of what you follow, visa, what bank follows, then there are not clarity about, say, certain GST aspects, certain TDS aspects. I think, we are just trying to solve for that. Otherwise, there are so many, co-lending technology partners also, some like, say, Knight Fintech, UB. I think those are, a lot of PSUs now basically want you to partner with them, and then only they are doing co-lending with you. I think, which would standardize this process, and probably, enable the NBFCs and banks to partner well, because otherwise, so if you have one, so let's say for a bank, they are partnering with, let's say, 50 NBFCs, right? And it would be good to have one platform whereby, they get their, MISs, their details. So I think we are moving in that direction, which is really good for the industry.
Okay. So I think one last question, which is very important in this current scenario, and in the future also, do you see the cost of funding decline in the cost of funding? Any change in the interest rate cycle? So although we are talking in the last 6 to 9 months that interest rate will go down, or the Fed will reduce, or maybe the repo rate will come down and all, basically. So being you are in that practice where you are dealing with the money. So what is your take on that independent view, that you see any decline on the interest rate side in the near future?
I think, the way I see it, that, not really seeing any rate cut in this calendar year, at least, maybe rate cuts are still, 2 to 3 quarters away. But, particularly for companies in India, I really don't see any increase in the rates. In fact, because of as I was telling earlier, the spread, is getting narrowed, and, because of, that spread narrow, because of, a lot of FPI money which would now flow into the bond market, which would, keep a tight lid on the GSEC rates. And so that's why, I think, and going forward, and NCDs would be a great source of fund, whereby, NBFCs can, borrow through that route at a lower spread. So, traditionally, let's say for a AAA entity, cost of funding may vary between, say, 80 basis point to 150 basis point of spread over where the GSEC is trading. So I think that spread is getting narrowed to, say, 120, and depending, where the market is. So probably, it is a good time to, benefit from this, spread narrowing, and, lock in some long-term money. And and of course, liquidity is also ample, with this money also coming in, we were already talking about, RBI doing, how do they are going to manage this money, because if they absorb dollars, then they would further infuse INR in the market, right? So to our mind, the liquidity is also going to be fairly in surplus, which would further help the bond market yields not to move north, and, be very stable.
Okay. So you see that there can be some decline in the future, near future, actually, from your point of view. Okay.
Yeah.
So Harsha ji, you have any view on that?
So my view is slightly different, to some extent, because the SBI just increased the short-term deposit rates the beginning yesterday. I think the banks, the credit deposit ratios have changed dramatically and showing some kind of strains there. So the growth at the banks level will be more deposit-driven growth, kind of. So the more the deposit they will have, and the more growth they can entangle, kind of, or they will envisage the banks to grow. So banks, there would be my take is that the banks will be fighting for the deposits going forward. More deposits they are going to get into their fold, to get more deposits into their fold, which can trigger a kind of increase the cost of borrowings for the banks, or cost of capital for the banks in turn, and then they'll have to pass it to maintain the same names also to the borrowers ultimately. So this SBI yesterday went 75% basis is a steep hike in the from a short term or perspective kind of. So which may trigger, because that will actually bring a lot of money to SBI from other banks right now to initially, but other banks will have to follow this kind of rate hikes. That's number one. Number two factor is that this being an election year. So this is an election year. So now the government borrowings are subdued in the first half of the fiscal. So probably whichever the government comes, the majority of the borrowings, bank borrowings are going to, or the government borrowings are going to happen in the second half. So that may have impact on the on the liquidity kind of going forward. But yes, from I agree with Aishwarya's view. The repo rate cuts or the that may not be seen immediately kind of. We are stable right now with inflation parameters and with a growth rate of around 6.8. So there's no need for any fiscal stimuli right now to be given to the industry. So I think we are there. But of course, the liquidity may dry out on second half. That is my assumption as of now. Plus, not more because of the liquidity perspective, because the banks would be fighting on for the deposits going forward. There could be impact on the lending rates by the bank. That's my assumption right now, to maintain the same kind of NIMs going forward.
Right. So thank you, Arshad. I think you rightly covered. Actually, there are scenarios which are different. Actually, which we were expecting. This SBI is increasing rate of interest deposit from 0.75 bips. I think 0.75 bips, 7.75 bips actually, which is the alarming situation for all the banks actually.
Yes.
So in near future, I believe we should not expect any rate cut or any decline in the rates of the banks actually.
But nevertheless, I think what Aishwarya ji was saying, I think that will also bring in a lot of money from international markets to the domestic markets, which should manage the liquidity. But we'll have to all see because where the dollar rupee positions, how the premiums are there, and what kind of inflows we expect on the debt side from the foreign countries to this country kind of. So the kind of that will provide equilibrium in the markets.
You are right, but sir, still we discuss further on that. Actually, if you see, the banks are majorly relying on the deposits. Actually, if you see,
I know,
and NBFCs are relying on the bank funding. Actually, so
absolutely,
it cannot be changed drastically in 1 year or 2 year. Actually, definitely the reliance will always be on the bank funding. Actually,
yeah.
So keeping in mind, suppose today we are at 57% of the bank funding in the average overall industry basis. Actually, and we may expect that it can come 50, maybe in 1 or 2 years actually. Below 50, I think it will take too much time, because ultimately the other sources of funding should be available. Either the DA or co-lending and this DFI funding and all. But if you see in overall funding, these are very small actually.
Yeah.
So mutual fund funding is something around 2 lakh crore out of 15 lakh crore funding of the banks actually. So the number will grow, but still we have to rely. So I think this overall debate and discussion was on the bank funding to the NBFCs. So yeah, we are seeing the scenario where the RBI is tightening the some kind of leverage to the leverage of banks to the NBFC side, and then the risk weight also, which is a new thing in the system, where the banks have to basically keep more capital for the NBFC lending. So this is another trigger to increase the cost of the lending to the NBFC. Another, you have rightly told, the deposits rates are increasing. So this might be. So in overall scenario, it looks like that this year the rates of the bank funding to the NBFC will not go down actually. Rather, they may be, this is my view actually, it might be increased maybe within 25 to 30 bips also. And maybe next year this might ease actually. So this is the view from my side actually. If you want to comment on that, I think we'll be happy to know also. And this risk weight also, I think it has added some cost already in the overall funding scenario or overall funding of the NBFC. So some of the NBFCs are got impacted by 10 to 30 bips the last 3 to 4 months actually. So is it possible to pass on this cost to the borrower actually? Because ultimately, how it will come out actually? You have to recover it from somewhere. So what are the tools for basically absorbing? Suppose, let's say, just for hypothetical situation, there is increase of 30, 40 bips in the overall borrowing cost. So as a practitioner, what do you see? What are the ways of adjusting or absorbing this cost in the overall NBFC system? So if you can cover like operational cost, which we can think of bringing efficiency more, technology can be one of the areas. So I think you can give more ideas also, because other people are listening, they will be knowing more about that actually. So if you can cover on that.
So, Ashish, my
So
take
should
is,
I?
if I should
Yeah,
I take this
please.
question? So my take is one that will depend on the kind of segment that you're financing under NBFC, not all. And typically, if you are directly competing in the segment with a bank, the bank is also considering the same line of funding. Probably the passing on would be slightly difficult because the differential or the delta between the bank lending and NBFC lending might increase to that extent. But considering that the industry that I am in, and we are financing education sector right now, so where banks are typically there in different segment, and we finance the international loans right now, where we have been able to pass on the increase to the lenders, in particular in our case, because it's not that extensively competitive, and the banks are not competing. But considering that the if a NBFC borrows and NBFC lends, the capital charge impacts both the assets and the liabilities, both the kind of. But fortunately for the sector like us, RBI has been kind enough to give away with for the education loans. They have not increased the capital charge on the asset side for us, kind of. So only it has increased for the on the liability side. So we have been able to pass on, but ultimately it will depend on the industry to industry and the sector that you are financing under the NBFC, whether you will to pass it on or not. Kind of how competitive is the industry right now.
Okay. Asha, do you want to comment on that?
I think I just like to add that, of course, passing on the cost depend on, the industry you are working, the segment you are working in, whom you are competing with. But, apart from that, basically, you can look at your liquidity strategy, how much liquidity you are keeping on your book, vis-a-vis, where you are parking that liquidity, so you can, save some cost by, let's say investing in a higher yielding. So of course, depending on what kind of risk you want to take, but let's say currently if you are parking some money in an FD, you can further look to buy some G-Secs. If you don't want to take interest rate risk, then currently in current market scenario, a floating rate government of India bond is giving you roughly 8%, right? So but depending on some bit of operational efficiency, you can bring in your liquidity management. For NBFCs, they can tap repo market. So whereby you can still create a longer term asset through GSEC, and then create liquidity through repo market. Still earn a higher carry. If you are keeping say 10 to 12% of your loan book as a liquid asset, you can try to manage that, build more pipeline, and have a little lesser on book liquidity. Apart from that, you can of course try to increase some bit of yield, operational efficiency you can bring in, try to reduce your cost to income ratios. So I think there, say 15-20 basis point, depending on the segment you are in. Of course, for a very large NBFCs, who are competing with banks, a 20 basis point is a very large thing to manage. But for a smaller NBFCs, if you are in, let's say if you are earning say between 12 to 14% on your asset side, 20 basis point is something you can manage.
Will technology will help in that reducing the overall cost? Because I was seeing in the newspaper that Kotak has given that information that they have 10% of the operational cost is a technology cost actually, and they are keeping it intact for every year actually. So this kind of because you have seen that they are digital. So RBI has also given some direction to them, but they are investing heavily on the technology side, and they are saying it is helping them to reduce their operating cost actually. So do you
Right.
think this will help the overall operation efficiency?
See, basically, that really depends on, organization to organization. Kotak is on a different scale, would really don't have much insight, how, which part of their operation they are investing in reducing their cost. But let's say for us, we are also a truly digital, company. We don't have any, so basically, at Vastu, there is no documentation or no paperwork we do. The only paper we sign is the last loan document, which by law you have to sign it, right? So of course, technology really helps a lot. And of course, if you are as large as Kotak Bank or SDFC Bank, there are a lot of ways in which probably they will be saving their cost.
Okay, Karsaji, in your case, because you are dealing with the international market actually, if you see. So will it help with better technology or maybe the more spending on the technology?
Sure, technology helps reducing the cost, but and definitely a lot of things still can be done digitally or electronically or through the technology. So we are also investing heavily on technology right now, and probably, and but it's just a long-term game kind of. You have to just sometimes you have to just get the cost right, and you have to put up the cost upfront before you start reaping the benefits over a longer period of time. So there's always a debate kind of whether this is the right time or you should do it when you attain a certain kind of scale, that kind of technology. So certain things you have to buy. Sometimes you have to bite the bullet and go ahead for the technology developments right now, because technology, I also say that technology is also culture for an organization kind of. If you adopt a technology earlier, you probably save a lot in terms of today. There are technology which is available for collections. Today there's a technology which is now how AI is now shaping up the kind of AIs, and which can actually prompt you for predictive analysis for defaults, other things, collective mechanisms. So a lot of things I think we will now depend, and with AI coming in, of course, a lot of things would undergo a change. My view is that kind of from the credit underwriting to collections to monitoring your pools, everything will be very different going forward. So I think one has to adopt to technology at an earliest, get that culture right in the organization, and you to get that cash flows right and invest early in the businesses so that you can reap the benefits when you reach a scale in the business.
Okay. So technology is always helpful actually, but depend on the organization to organization,
Yeah.
how you want to adopt it actually. So great, sir. I think we have done a lot of discussion, and I think a lot of things which we have discussed will be helpful to our audience. And because as you know that RBI is tightening the norms and all, so we need to discuss all these things on regular basis. And it has come out that it is important at this juncture to, I think, adopt the alternative sources of funding, the NBFC overall ecosystem, because those NBFCs who will take these initiatives, I think they will not face any challenge in future on the funding side, because you have to maintain your growth actually. For maintaining your growth, you have to have the alternative sources of funding. So like the co-lending or maybe DAPTC or the bond market and all these DFI funding. So these things are there, which I think the every treasury person or the CFO of the company in the NBFC space should devote some time or should spend, I think, energy on that actually to understand and to go for that, to try on that these products also, which will be helpful to diversify the funding side. And whatever the way the government is trying and all basically, then I think it will be helpful to all of you. And there are a lot of advantages are those there that Aswaji told and the Sanjay has told. There is no challenge on the co-lending. There is no challenge of the ALMs which are there actually, and then no limit of funding. There's Ajit ji has told that there will not be any limit of funding actually. In case of borrowing, there is always a limitation that banks are having their exposure norms and all. So there are advantages of these products, but again, the technology is one of the hurdle actually. So when the technology will be better, I think the more co-lending will be done in the Indian market actually, and this will be helpful to grow the book of banks also and NBFC also. So, friends, I would like to thank you to all of you for joining with us, especially to our panel speakers. Ajit ji, actually he left early because he was traveling somewhere. And then Bonani ma'am also, she was having another meeting, so she not here now basically, but she has joined with us and she has given her views also. And then Harsha ji and Aishwarya ji, both of you are basically having a lot of other things actually, and you could find time for this webinar. And your views, I think all views of all the speakers are very important for the industry people, for the even the banks. Many banks people are listening this webinar because they have joined from YouTube or maybe LinkedIn, and so directly they may not have joined with the Zoom link actually, but they have joined on other social media channels. So I think it will be helpful to all the industry players, all the ecosystem to know more about that, how can diversify the funding sources, and what are the pros and cons of these sources actually. So I would like to thank you to all of you once again for joining with us, and wish you good luck. Actually. Thank you very much. Thank you all. Thank you,
Thank
sir.
you.
Thank you, Ashwin. Thank
Thank
you,
you.
Ashwarya ji. Thank you, Resurgent
Thank
team
you.
also for managing this. Thank you, Parisha. Thank you, Ayush. Thank you, everybody. Thanks a lot. Thank you.
Thank you, sir.
Thank you, sir.